Well, Asian markets, they're off to a weak start early today. The Nikkei is trading with deep cuts on the first trading session for this year. The market, in fact, is also taking cues from the weak handle that we got on Wall Street, where the Dow plunged over 600 points. In terms of data, the Japanese December final manufacturing PMI, that came in at around 52.6. That compares with the reading of around 52.2 on a month-on-month basis. Keep in mind, for the Japanese index, you're also looking at the yen. That's an export-oriented economy. For them, they would like their currency to be weaker. But just take a look at what's happened. In the last 10 days or so, on safe haven buying, we're seeing buying on the yen. So that's why we're seeing the dollar-yen has moved from around 111 odd to around 107.5. For an export-oriented economy, it's not great news when your local currency is strengthening. And that's why that's playing a bit of catch-up. In fact, that's down close to around 3.5%. But it's not just the Nikkei, actually. The other couple of markets as well, they had opened up more or less flattish or with a bit of a negative bias. The Kospi is down 0.2%. And the other couple of markets as well, the Taiwanese index had opened up with a cut. So let's keep an eye out on that one. That's down close to around 1% as we speak. Even the Straits down 0.2%. Remember, in terms of the Nifty, we've seen a correction in the last couple of trading sessions. For starters, we're likely to see another 25-point downtick just to kickstart trade. Whoopsie daisy.
Yeah, it doesn't look so good, but let's talk about the U.S. markets. They also didn't look so good. U.S. stocks fell sharply, with the Dow Jones Industrial Average sinking more than 600 points as Apple posted its biggest percentage drop since 2013. The S&P 500 pulled back 2.47%, while Nasdaq, that tumbled 3%, as the technology sector, that fell around 5-odd%. Investors also reacted negatively to a weaker than expected reading on manufacturing activity. The ISM Manufacturing Index fell to 54.1 in December versus expectation of 57.9. CNBC's Aditi Roy gets us a wrap of all the action on Wall Street.
U.S. stocks getting slammed today on Wall Street. The Dow off 660 points, the S&P down 62, and the Nasdaq losing 202 points. ADP private payrolls outpacing expectations, adding 271,000 jobs in December. That comes as concerns grow about an economic slowdown in the U.S. This was the highest increase for private sector jobs since February of 2017. Meantime, a key reading of the U.S. manufacturing sector plunging more than expected last month to its lowest level in more than 2 years. Meantime, Apple shares suffering their biggest single-day drop in 6 years, tanking 10% after the iPhone maker slashed its 2019 first quarter outlook yesterday. Apple saying sales are taking a hit thanks to a disappointing upgrade cycle and a weakening economy in China. And Bristol Myers announcing plans to buy cancer drug maker Celgene for $74 billion today. Celgene shareholders will receive a little more than $102.43 a share. Celgene gaining 33% on the news. That's the action from the U.S. market. Back to you in Mumbai.
Well, let's get in some opinion from Mohammed Al-Aryan, who says there is evidence that the U.S. economy is slowing.
In the last 3 months, the view has been the rest of the world is slowing, particularly Europe and China, but the U.S. has enough momentum. Now, there's two types of concern. One is that the policymakers aren't sensitive enough to the spillbacks, to the possibility that we get contaminated from what's happening abroad. And the second concern is that market volatility could feed back into economic weakness. So it is different. This is a different type of concern than it has been earlier. And it speaks to how do you regain the momentum? How does the Fed regain control of its narrative?
Well, all right. Let's turn our attention to the European markets then. It's quite interesting out there because remember, Apple cut its guidance, and that's what really sparked fears that we're heading into a global economic slowdown. On the back of that, those indices, they ended sharply lower. If I take a look at that, the FTSE ended with a cut of close to around 0.5%. The CAC was down more than 1% in yesterday's trading session, and the DAX as well was down close to around 1.5%. So it wasn't very, very good reading yesterday. The markets were as is nervous heading into the trading session, expecting a sharp cut on the US markets, given that we already had the Apple news. But so that's about the European markets. I think for the time being, what we'll do is we'll slip into a short break. You come back, we'll continue with all the global cues, as well as the cues that are stacked up for us when we open up for trade in the next couple of hours. Don't go anywhere.